The silver market just crossed a point of no return. For decades, one number controlled everything, $100 an ounce. And now it's not just above it. It's trading as high as 115.59 spot, with China printing over 110 on futures. That's not a breakout. That's the market admitting the old ceiling is gone. Here's the contradiction that makes this moment dangerous. The higher silver goes, the more people want it. Triple digits aren't scaring buyers away. They're pulling them in. And if you're sitting there thinking, I'll wait for 90, you may be waiting for a price that never returns. But here's the part nobody is saying out loud. Once silver enters price discovery, history stops helping you. New floors form fast, and the window to act shrinks in real time. So the real question isn't, will it dip? It's what breaks first, your timing, your liquidity, or the physical market itself. Most people are treating this like a normal rally, a spike, a pullback, and then a chance to get in lower. But the event you gave me isn't just silver up. It's the moment the market crossed a psychological containment line and started behaving like something else. The $100 level wasn't just resistance. It was a mental barrier that kept buyers cautious and sellers confident. Now that barrier is behind us, and silver is no longer negotiating with history. It's moving into price discovery, where there's no familiar ceiling to lean on. Notice what they didn't deny. Nobody is calling this a temporary glitch. Even at 115.59 spot, the tone shifts from maybe to confirmed. And that forces a reframing question you can't avoid. Are you still treating silver like a value trade? Or are you watching a momentum trade that compresses your decision time until hesitation becomes the most expensive choice? This is where the story flips from price to velocity. Because the most important detail in your material isn't the number on the screen. It's how fast the market is traveling between numbers. You provided the comparison. Moving from $20 to $30 took 145 days, but moving from $90 to $100 took just 10. That is not a strong trend. That is time compression. And when time compresses, your old habits stop working. Weekly analysis becomes too slow. Waiting for a perfect entry becomes a luxury you don't have. Now watch how fast this escalates. If $10 can happen in a week, then $50 doesn't require years anymore. It can happen in a handful of chaotic sessions. That's why projections like 150 in weeks and even 200 in months suddenly stop sounding crazy. But here's the part nobody is saying out loud. In a melt-up, the biggest risk isn't buying high, it's staying out, while the market builds new support above you. Now the pressure moves off the chart and into the physical plumbing of the market. Because your source material reveals a structural break most people won't see until they need to sell. Refiners are effectively stepping away from secondary silver, 90% constitutional coins and sterling, either refusing to buy it or delaying payment anywhere from 10 days to 3 months. That creates a split market. .999 fine bullion stays liquid, while legacy silver can become a trap. This is where the story flips again. In theory, your junk silver rises in melt value with the spot price. In reality, dealers can't tie up cash for months just to wait on a refiner payout. They run on velocity, buy, move, repeat. And when that cycle stalls, they stop taking the product, even if the price looks amazing on paper. Notice what's missing from the hype. Nobody talks about the exit door. And in this environment, liquidity isn't a detail. It's the difference between winning and being stuck. Here's where the market sends you a signal that isn't coming from traders at all. It's coming from a sovereign issuer. Your source says the US Mint repriced proof silver eagles to over $170 per ounce, roughly double the spot price at the time. That's not a rounding error. That's a statement of expectation. Because the Mint doesn't price like a panic buyer. It prices like an institution that refuses to be caught behind the curve. This is the part nobody is saying out loud. when an official issuer anchors at $170, it's quietly treating $100 to $115 not like a peak, but like a base layer. And the spread creates a strange distortion. If you can buy silver at a local dealer near spot, you're suddenly sitting on a massive gap between street price and official price. That doesn't mean free money. It means the system is admitting scarcity, premiums, and future repricing are becoming normal. The real question is, what happens when the rest of the market catches up to that anchor? Now, the frenzy arrives, and it changes the physics of the market. Your material describes a whole new universe of buyers flooding in, many with no real understanding, just reacting to headlines and the visible erosion of purchasing power. And instead of demand cooling at higher prices, it intensifies. That's the Veblen effect in real time. The price goes up, and that becomes the advertisement. Dealers report buying 6 figures of inventory daily. Yet showcases stay empty because retail offtake is instant. Now watch how fast this escalates. Once the public sees triple digits, the act of buying becomes emotional, not analytical. And that emotion creates local scarcity, which pushes premiums higher, which pulls in even more buyers. But here's the part nobody is saying out loud. Mania doesn't just raise your gains, it raises your cost of entry. If you're still accumulating, every hour of hesitation can mean fewer ounces for the same money. And in a physical market, that's not theory. It's the moment you walk into a shop and realize nothing is left to buy. The most surprising shift in your source material is this. The short side is gone. Not weakened, gone. Millions of shares available to borrow for shorting silver. Yet almost nobody is taking the trade, because doing so now is described as pure insanity. That's not just sentiment. That's institutional capitulation. And when the short crowd exits, the market stops getting dragged back down by the same old weight. This is where the story flips. The violent downside smashes you used to expect. The sudden $5 drops in minutes become less likely, or at least far less effective. Notice what they didn't deny. Nobody is talking about suppression as the dominant force anymore. Banks that once benefited from controlling silver now benefit from owning it. If major players are aligned with upside, waiting for a manufactured crash to buy becomes a strategy built on a world that no longer exists. And in a momentum market, that kind of waiting doesn't protect you. It quietly removes you from the move. Now it stops being about traders and starts being about your life. Because silver at $100 plus isn't just a chart. It's a signal that money is being questioned in public. And when that happens, the consequences spread fast. Premiums widen, inventory disappears, and the cost of waiting turns into the cost of missing. If you're trying to build protection for your savings, the market is forcing you into a new reality where the same paycheck buys fewer ounces every week. And if you ever need to sell quickly, your ability to do it depends on what you hold. 999 fine bullion stays moving. Alloyed products can freeze. That difference matters when bills don't care about spot price. This is why people are driving hours to avoid a 10% bullion tax, crossing borders just to keep more value in their hands. It isn't ideology, it's survival math. And if this feels familiar, say so in the comments, because a lot of people are realizing the rules changed long before the headlines admitted it. Here's the systemic mechanism underneath everything you gave me. This isn't just demand rising, it's friction rising, and friction is what turns a normal bull market into a disorderly one. Refiners slowing down on secondary silver creates bottlenecks. Retail mania empties shelves faster than wholesalers can restock. Sovereign pricing sets a new psychological anchor far above spot. And institutional short capitulation removes the usual counterweight that would cool the move. Put those together, and you get a market that doesn't just climb, it lurches. This is where the story flips from price appreciation to control loss. Because when the system can't smoothly absorb buying and selling, You don't get clean pullbacks. You get gaps, premiums, delays, and sudden repricing across regions. And the most unsettling part is how quiet it looks at first. Everything seems fine until the day you go to buy and there's no inventory, or you go to sell and there's a waiting period. Notice what's missing from mainstream coverage. They talk about price like it's the whole story. But the real story is the infrastructure straining under the weight of its own success. Now zoom out, because your source material shows the center of gravity shifting east, and that changes who sets the real price. The Shanghai market is trading silver at roughly a $10 premium over Western spot, which turns global inventory into a one-way river. If metal sells higher in one zone, it gets pulled there, and the West doesn't get to keep a lower price without watching stock drain away. Now watch how fast this escalates. Any dip in US pricing becomes an arbitrage opportunity, and arbitrage doesn't hesitate. It buys, ships, and repeats until the spread closes. That's why the screen price you see in the West starts acting like a lagging indicator. The leading indicator becomes the premium because it tells you where the physical demand is strongest and where the market is willing to pay more right now. But here's the part nobody is saying out loud. When another region consistently bids higher for the same metal, the old dollar-based anchor weakens. And once that anchor slips, the floor under silver doesn't feel like $100 anymore. It feels like whatever the global buyer is willing to pay next. At this stage, the smartest move isn't just buying. It's positioning for what comes after the surge. Your source gives you the key lever. The gold-silver ratio has compressed below 50 to 1, with gold near 5,000 and silver above 100. That tells you silver is outperforming, exactly what high momentum cycles look like. And yes, the ratio could compress further, toward 30 to 1 or even 15 to 1, which would imply even more upside. But this is where disciplined investors start doing something the crowd won't understand: rotation. A staggered exchange from silver into gold doesn't mean you're bearish. It means you're locking volatility into permanence. Silver is the sprint. Gold is the storage. And when the cycle matures, what matters isn't how high the chart went. It's how much purchasing power you kept when the move cooled. Notice what's missing from most silver to the moon talk: an exit plan that doesn't rely on perfect timing. Rotation is how you win without needing to be psychic. The deepest insight in your entire source set is this: after $100, silver stops being a price and starts being a test of systems, a test of liquidity, a test of supply chains, a test of policy, a test of human behavior under pressure. Because the three futures you laid out can all be true in different ways. Scenario A is the melt-up. Silver runs from $100 to $150, then toward $200 in months, and the move becomes historic, not because people got smarter, but because the market loses control. Scenario B is the structural grind. Silver holds above $100, volatility shakes out weak hands, and the floor stays high because the bid becomes institutional and persistent. Scenario C is the liquidity trap. The spot price looks strong, but the physical infrastructure breaks, spreads widen, taxes expand, and some holders discover they're rich on paper, while the exit door narrows. And here is the one sentence that reframes it all. In a breakout cycle, the biggest risk isn't being wrong. It's being unprepared for the way the market changes shape while you're staring at the number. If you want the next layer of analysis, how to build a strategy that survives all three scenarios, follow and subscribe, because the real story isn't just where silver goes next. It's what your options look like when it gets there.